Hello, everybody. Thank you very much for coming. Looks like this is the room for the crypto enthusiasts. We have a talk not too long ago about a bank that does business with blockchain. That's awesome. In our case, I will tell you a bit about how to trade using Kafka. And well, but first, a bit of a disclaimer. Who am I? Well, I am probably one of the most critical people here about all the big data stacks. Okay, I don't like too many virtual machines running virtual machines that run virtual stuff. I've been a sysadmin for a lot of time, almost 20 years. And well, if you ever have any question about how stuff can go wrong late at night, just come here and call me. And first of all, disclaimer, this talk is very high risk. Don't try this at home. I know you will do it, okay? Because if not, you wouldn't be here. Crypto markets are very risky. There's a high volatility, prices go up and down very quickly, and most markets can be manipulated. And of course, this is not a very good idea. And by the way, this talk reflects my opinion, not my employer's, just in case this talk doesn't make me fired. So what's about automated trading? Well, automated trading more or less starts in the 80s, and it was something like, okay, let's try to take the human part, at least the most complicated to manage part of the human part of trading, replacing it with machines that don't have sentiments, don't have fear of losing anything. So mostly it was like, okay, I have some set of rules, and with that set of rules, I trade, open a trade, close a trade. Later on, probably you have heard something about this stuff called high-frequency trading. High-frequency trading is considered the evil of a lot of stuff that's going on Wall Street. It basically means that you trade automatically at millisecond level, and you trade very different markets at once. And it was a very, very expensive way to do business. Just 10 years ago, if you wanted to do this, you had to buy software that was priced about 20 or between 10 and 20 $1,000 per core. That was really, really expensive, no? But now it's different. It's a bit different. Times have changed. So how can we trade cryptocurrencies now on a basket, okay? First, we need an exchange. What's an exchange? An exchange is a place where people lose money. Okay, probably you will trade, you will win some money. Good for you. Congratulations. But if you make some money on exchange, that it's only because someone else is losing money. And believe me, if you're trading, you will lose money. You cannot avoid losing money if you're trading. Maybe if you have a good strategy in the long term, you will have some money, more money than what you started. But I can guarantee you that you will lose money. So, the most important part of the exchange is something called the order book. The order book is like the god of the exchange, and looks like this. It's a huge table where you can see the price, and not only the price, but where people is going to buy or sell a certain amount, a certain security. In this case, this is a Bitcoin. Bitcoin yesterday at 2 a.m. And, well, you can see a huge spike here in red. That means, well, there was some barrier to the currency to start going up. it's much interesting to see this live because it moves and when you have your money there, it could be pretty scary, which is good. So think of the order book as a queue, okay? In a market, an exchange, all orders are queued. Why? Because if you want to buy something, you will buy something always for the best price if you buy at market. So the order book is actually a queue. A queue on every step, on every register, is a position. And behind every value you see in the order book, there could be 1, 2, 1,000 orders. You don't know how much people is behind every step in the order book. But there is something very important. For every price, orders are executed always on a first come, first served basis. So, there's also a very, very, very strong incentive to always be the first on the order book. Because if you are the first, for that price, your order will be the first to be executed, and you will be the first to make money before anyone else. And also, there are some markets, especially cryptocurrency markets, where there's an incentive to be a market maker. A market maker is someone that puts orders on the order book. I mean, if I want to sell Bitcoin at $8,000, probably I could be the first one. I am the market maker. If you want to sell it to $8,000, you are a taker. You close the other part of the transaction. Okay, there are markets where we have very low fees, even 0 fees for trading, if you're a market maker. So there's a strong incentive to be a market maker. So a good strategy to trade cryptocurrencies is to choose a good exchange that does that, and also be a market maker. And in order to be sure you're a market maker, be sure to be early in the order book. Send your order as soon as possible. There are people that is hosting their computers in the same place that the exchanges are, because that way the network goes very well, and they will get execution before other people. So how can we do this? Well, with Kafka streams, and KSQL. Why? Well, this talk is about Kafka, so we'll try to use Kafka. That's normal, right? Kafka streams looks very good, because if you got something on Kafka with very minimum effort, you can do a small ETL stuff that actually can be even more interesting than the simple ETL. You can do almost a CPE, complex event processing. And KSQL, which is a brand new stuff, allows us to prototype quickly. Developing Kafka streams means that you have to open Eclipse, build a project, debug it, and it's time-consuming, right? And not everybody can do this. On the other hand, KSQL is much more easy. So why? Why Kafka? Well, Kafka because I love Kafka. I really Okay, thank you. Well, why Kafka? Kafka because I love Kafka, really love the software, really love streams. When I first saw streams, I thought, okay, this can be good for trading, but no. We needed something more than just Kafka. We needed exactly once processing. This is new in Kafka, and basically means that if we have a strategy that says, okay, buy at 100, I received that message only once. I don't receive 2 messages. Okay, okay, buy 100 twice. No. If I have one signal, I need to read one signal. If not, I'm going bankrupt just because the technology is not good enough for me. And, well, the third reason, KSQL. KSQL makes working with streams really, really funny. It's like SQL, not exactly, but, well, you can make whatever looks like a chart when you graph it with a simple statement. So the ideal architecture for dealing with this would be, first we have the exchange. We grab data somehow from the exchange. Usually you get it from a WebSocket. Okay, there's no, there are at least two markets that have something more sophisticated than a WebSocket, but the important part is that you usually have a WebSocket connection. You could grab it from Kafka Connect, get into a topic, do whatever with this until you have something, a queue, a topic that says, this is the execution topic. And with the Kafka consumer, you end up consuming, doing the actual market trading with all the signals you grab from Kafka. Well, the reality is not that beautiful, because there's no Kafka Connect WebSocket component, at least not one that's good enough. And I guess it will take some time to develop a good one, because every exchange gives you stuff in a very, very different ways. So you will have to grab the data somehow and drop it somehow into Kafka. And maybe next year we'll have something, I don't know. So let's try a simple use case that how can we use Kafka to start trading. In that case, we'll use a shotgun order. A shotgun order is an order, market order, where you want to trade for a price. Instead of trading for one price, you break the order into very small ones, and in order to exploit the properties of the order book, you split it in different prices around the one you want, trying to probabilistically get into the order book first and be a market maker. So this looks more complicated than it sounds. The tricky part is thinking about how to do everything in sync with speed. But okay, perfect. So we have someone. Usually it will be you at first. Maybe you have a very special AI. You have a program that says, okay, market signal says that I want to trade. And I'm thinking about a set of market orders, set of prices I want to trade. So I put it on Kafka, and with streams, I convert that price candidates into a Kafka table. I join it with the order book. KSQL is good for that. And finally, since I have a table with this, I can throw that to the robot that does all the market execution. Okay, sounds beautiful, right? You will have bugs. And it's not as smooth like it sounds, because sometimes you will be a bit nervous about what's going on in the market, but it works. Well, at first, we need to reconstruct the order book inside a Kafka topic. On the right, well, you know the order book, our friend, and we have some market data. Well, this is from a WebSocket connection. It's been tweaked in order to be able to be processed by Kafka. Well, the first thing we have to do is to convert that data from the order book into a stream. And, well, create its stream from market. In that case, there's a bit tricky because we have an array and, well, the examples in KCQL are not very clear. So, well, the guys from Confluent told me, no, try to do it this way, and it works. It works this way. Always try to describe whatever you do with KCQL, okay? Sometimes the stream will think that the data is in one format and will be another one. And that's what happened to me. The stream were mostly strings of characters, and I had it to convert it to numbers. And it was not easy. It was not easy because I spent almost a week, a whole afternoon tweaking and looking at a bunch of errors, and until I found out, okay, I'll try to cast it with some black magic. Let's see if it works. Remember that KCQL is not yet complete. It's alpha quality software, so be careful with it. You will find still a lot of stuff that it's not yet working. The people from Confluent is still working on it. So, well, file a bug if you find something that it's not as you expect. And, well, with that, we can select the price. We can get a summatory of how much stuff is on the order book, and we can group it, and magically we have something that recreates the order book. Perfect. Just half of the work. Well, now we have to see if the spot in the order book is already occupied or not. So, make another price candidates topic. You know, the topic that the man was thinking about in the other slide, in drawing, right? Well, we make that, we take it from the topic, and make a table, and finally we join it. And with this, we know what's happening in the order book with the prices we want to trade, okay? With this, you can start trading. In fact, with this, you should be looking what's going on there. Why? Because maybe you're the first to trade on that particular price. Maybe you're not the first to trade, so maybe you should cancel some orders that go at that price level. And with this, you can start losing or making money. I hope you make money, because the big picture is that we have seen only the part in red that stores market data and more or less gives you a signal that executes trades. If you are serious about trading algorithmically, trading using Kafka or whatever technology you want, please take a look at this big picture. I'm sure there are missing parts, but you have to get market data. You have to store it somewhere. Please replay it. Test your assumptions, test your strategies. Try to test it even with random data, random entry and exit points, because you will be surprised that testing your strategy gives you strange stuff. Maybe you're looking only at I am winning, I am losing. No, that's an error. Look at how much drawback you have in your model. What is drawback? The amount of money it is losing. Because you will lose money. Because an algorithm cannot shape perfectly the market, which is more or less random. So take a look at your drawback. Take a look at the maximum amount you're losing. And don't trade if you're not comfortable with it, okay? Maybe you have a really impressive strategy that gives you 25, 35% earnings. Perfect. But if you're not comfortable with losing 3 Bitcoins, that strategy will not work for you, because as soon as you start running it, and believe me, I did, you will stop that strategy, and maybe you will exit the market in the worst place. Okay, we'll need also to watch for exit signals and to manage the risk. So we are not trading for much more amounts of money, or markets without too much variance or too low variance. We want to be more or less sure that our markets have the right volume, that everything is going to be executed. And also, it comes the hard part. You have to predict order book changes. And that's all. Thank you very much for coming. I'm pretty sure you will have a lot of questions. You have my Twitter address here. Ask me whatever you want. I'll be really happy to and really glad to answer your questions. Thank you very much.